Well, because we know that real estate is unaffordable in a lot of metros across the country. All right, well, let's start with rates. As you guys know, I get an update every Tuesday morning from my rate guy. So I'll give you the latest and greatest. Here's what he said. He said, "Good morning, Lee. Punxsutawney Phil saw his shadow again. So those of you guys know, yesterday was Groundhog Day, and he did see his shadow. So apparently we're getting 6 more weeks of winter, if you didn't know that. So happy Groundhog Day. This was yesterday. Bonds reacting unfavorably as today's economic data unexpectedly stronger than anticipated. Rates are flat from last week. We may see volatility over the next 2 weeks as more data is forthcoming, but the Fed is not expected to cut rates anytime soon. Make it a great day." And then he goes on to give us the rates. And here's what they look like up close. Hopefully you guys can see these. I don't know if that's going to come into focus. Not coming into focus. Okay, well, I'll give you the ones that matter. Here they are. FHA 30-year fixed sitting at 6.055. The VA 30-year fixed sitting at 5.771. Remember, guys, the magic rate number is 6.5%. So anytime we see rates at 6.5, that's good. Oh, I'm sorry, at 5.5. That's what we're looking for. The USDA 30-year fixed is 6.178. And the conventional 30-year fixed is sitting at 6.143. We are hoping to see some rate adjustments in the meeting of the Feds last week. That did not happen. Rates held steady. And so we believe that's probably going to be the case pushing through May, where we should be getting a new Fed chair. So we'll see how all of that shakes out. Okay, a couple of things in the news, again, related to the Federal Reserve, and we are getting our news from the Kiplinger letter. If you guys are not subscribers, you should be. This is what it looks like, the Kiplinger letter, and this edition is specifically for executives and investors, okay? The Kiplinger letter has about 30 different versions of its publication. You guys want this one specifically, executives, forecast for executives and investors. So here's what they're saying about the Feds, and then I'll share with you what they're saying about housing. Federal Reserve is on hold after a series of interest rate cuts last year. The next cut may not come until late spring or summer. Chair Jerome Powell indicated after this week's Fed meeting that the Fed thinks rates are low enough to support the economy. December's jobs report showing a tick down in the jobless rate gave him and his colleagues some confidence that the labor market isn't falling apart. Inflation remains a stubborn problem, refusing to return to the Fed's 2% goal. Cutting interest rates further will be harder to justify if price gains don't slow first. We expect some modest cuts in the second half of the year, but nothing dramatic. So rates are pretty much where rates are, and it's both good and bad. It's good for this reason. One, pricing is going to stay relatively the same. The good news is that sellers are going to have to discount their properties even more if they want to get their properties sold. Why is that good? Well, because we know that real estate is unaffordable in a lot of metros across the country. And so as long as rates remain where they are for houses to sell, sellers are going to have to discount their price, offer concessions, offer various incentives, which should get the average sales price down. If we can get the average sales price down, we can move properties into a more affordable price point. And when rates do decline, more and more people are going to be able to afford a mortgage. One of the numbers that you guys need to be aware of is 25 basis points. So please write this down, 25 bips or BPS, or you would see it as 1/4%. So 25 basis points in a reduction on rates creates 5 million more homeowners that can afford to buy a house. So when rates come down 1/4 point, 5 million more people can afford a home. When rates go up 1/4 point, 5 million people can no longer afford a home. That's how thin these margins are. So if we see rates drop 1%, it means that 20 million Americans will now suddenly be able to buy housing, and that's going to create a disparity in the marketplace, and we're going to have more buyers than sellers, and we're going to see prices rise, which is not what we want. We want to see prices come down and stabilize. And so the Fed holding rates where they are, in my opinion, was a smart move. I know we'd all like to see rates come down, but they need to hold, and I think they did the right thing. So this brings us to the section on housing. An early look at where Americans are moving within the country. Areas with affordable housing continue to attract transplants, per a report from Bank of America on the changing addresses of its tens of millions of customers. Midwest metros like Indianapolis, Cleveland, and Columbus, Ohio are draws for relocating Americans, plus established hotspots like Denver, Colorado, and Austin, Texas. High-cost metros continue to lose residents. The early banking data shows that New York, Los Angeles, Boston, San Francisco, and Washington, D.C. are seeing population decline. Ditto for metros in Florida that were popular destinations after the pandemic, like Miami, Orlando, and Tampa. So if you guys are flipping, the markets to be flipping in are the ones where people are moving. Indianapolis, Cleveland, and Columbus are some of the better markets to be flipping. So for my private money brokers, you guys are going to want to be running your ads in Cleveland, Columbus, and Indianapolis on Craigslist ads there in those markets. Also, for those of you that know how to do this, you can be running ads on Facebook and Google targeting these areas specifically, because that's where you're going to see more volume flipping occurring, is in these markets. Other metros that are seeing population decline, most investors are avoiding or they're holding because they can't sell the inventory. They don't have enough people moving into those areas. So this is how we take the news, you guys, and apply it to help us be better brokers, better investors. Okay?